The presentation I'm giving you today is pretty much a summary of what I've been writing about and what I've been telling investors ever since we went into 2022, and that means that I have become a cautious investor this year, and I do very well realize that when share markets are riding onto a new high, me being cautious looks completely out of sync with what is actually happening out there. And then when share markets go into a downward tailspin, all of a sudden I look like I'm behind the curve because it's already happening. My presentation today is not so much focused on what is happening immediately in share markets, but I do think there are plenty of reasons to be a little bit more cautious this year, because there's a lot of drivers that previously were contributing in a positive manner to the direction of equity markets. They've now turned, if not reversed, and they are deteriorating. In a very simplistic form, one could say that risk is accumulating for the share market, and as investors we should all be aware of this. Having said so, I do wish to emphasize that, of course, everything I say today is no financial advice. I'm simply sharing my ideas and my insights, and also in the way that I behave myself in the share market and have behaved myself this year. Now, if we look at the general context this year, I mean, I've tried to put a few things together here that might be impacting on share markets today. But I think there are two key elements on this slide. One is in the middle, where I ask myself, have I forgotten anything? Because there is quite a lot happening in today's world, and not all of it could be accurately predicted by any of us. And then the quote at the bottom, I think we shouldn't necessarily focus on the fact that this financial expert thinks there will be no positive returns for investors this year. That is still debatable, I think. But I think the key element here is that earnings forecasts around the world are probably too high for this year. And that's important because traditionally, if earnings forecasts are falling, and they are only starting to fall right now in certain regions, then usually the share market does follow the direction of the earnings forecasts. And so from that perspective, it's quite important to gauge why earnings forecasts might be too high this year. The immediate cause for earnings forecast to drop, of course, this year is because we have inflation. And inflation doesn't just impact on bond yields and on central banks. It also impacts, of course, on company margins and on household budgets. And I think that we all have experienced now that there's a lot of stuff out there that is just simply rising in price on a regular basis. And it impacts on our capability to spend as consumers. And it impacts, of course, on businesses, on their capacity to keep on making what they're making, keep on selling what they're selling. But they may not necessarily be able to do so with that same margin that they had last year. And that's important because that might, all else being equal, put pressure on earnings forecasts. And that's the reason why we may be bracing for a very important August reporting season this year. So far in Australia, earnings forecasts are still rising, but that is because of the likes of BHP, Rio Tinto, Woodside, Santos. That type of company is still enjoying stronger for longer commodity prices. All the other companies in the market, they have to endure the price rises, and that means pressure on margins. Having said so, it doesn't mean that the only alternative here is to put everything in cash and to wait it out, because that's not how financial markets work, of course, and that's not how investing works either. What I have done, and then what I've tried in this presentation, is I I'll go back to the base, and when I manage money myself, and when I share my ideas with investors, I always come back to the firm belief that a successful investor is someone who reduces and manages risk. It's not someone who takes on risk. So in particular, in a period like this year, when I believe risk is accumulating and is becoming very tangible, I think those strategies that we should employ successfully are around reducing risk and managing risk. So I've put together a few ideas in what way that can be done successfully. And the most obvious one this year is by reverting back to what is so-called the reopening trade. And the reopening trade has been around since 2020, ever since we had societies going into lockdown, and a lot of businesses all of a sudden could no longer do what they were supposed to do. And that was in many cases, that was opening up shop and selling to customers. Now, the reopening trade over the past 2 years has been very much a stop-start experience, and a lot of excitement in share prices has come out and then has come back into again, has come out. So it has pretty much been a very slow and often a very frustrating process for investors. But this year, I believe, and I've seen some fund managers completely redirecting their portfolios in this direction. This year, I believe there will be more substance to the reopening trade in a general term, but there's also another angle. The other angle is that as long as you can keep a carrot in front of investors, they are willing to give companies the benefit of the doubt. And I think the reopening trade is one of those carrots. Now, even if the recovery in the businesses that have been impacted by COVID over the past 2 years, even if that recovery will be slower and more gradual than we all would like to think, I think that still means that those share prices, to a certain extent, will remain supported this year, because there is that prospect of tomorrow will be better than last year. And on the top of the list here, of course, I've put the most obvious examples that investors like to play this theme through. It's obviously always about travel agents, airports, and airlines. But we shouldn't forget that toll roads in itself are, of course, very much linked to the reopening trade. And I've added a few maybe some lesser known examples. And there are some New Zealand companies listed on the ASX, and there are some smaller companies like a Serco and a Calcium Group, for example, that may not necessarily be well known amongst a wider group of investors. However, I'm actually a big fan of the next set of companies, the healthcare sector. And I think the healthcare sector is very seldom pointed out as an obvious reopening trade. Also because when people think about healthcare, they usually have this idea that these are large cap companies trading on significant premiums, so you can't possibly own them in a time when bond yields are rising. I think that image will gradually change. And I'm a big fan, of course, of the big three in Australia, the Cochlears, the CSLs, the ResMeds. They've all been impacted. They all are, to a certain extent, a reopening trade. You can see here from the slide that it still mentions Ramsay Healthcare. That would be the most obvious candidate in this trade. But obviously, by now we know there's a bid being offered for the shares. At the bottom, I mentioned two companies that were previously priced as winners of the COVID pandemic, the Helios and Sonic Healthcare, because all the testing we did was obviously done by them. Those share prices have sold off this year very firmly. But what investors tend to forget, I think, is that the core businesses of what these companies do, they have been impacted massively by COVID, and they obviously will be ramping up again. So there is an element of reopening trade also in some of the healthcare companies that were previously seen as major beneficiaries. Now, we can obviously reduce risk in many other ways. And what has happened this year is that the so-called bond proxies in the share market, they've been hit very hard. And that's not that surprising, because when bond yields go higher, it does impact on share prices. It does impact in particular on those share prices whose valuation is very much linked to bond yields. Now, however, I have been saying this since last year already. I do think that the local bond market in Australia is pricing in way too much. They are pricing in so many rate rises by the RBA that the RBA couldn't possibly meet expectations priced in by the local bond market. Now, I believe that the bond market locally is pricing in so much because investors realize that in the US, however, the Federal Reserve is behind the curve and will have to step up its tightening cycle. And that has a lot of dangers, and that also so people have priced in a premium in the local bond market also because we are a smaller market, etc., etc., etc. Long story short, what usually happens is that companies like REITs, they correct well in advance of any tightening by central banks. So there is a fair argument to be said that correction has already happened, and many of those share prices, they look very, very favorably if you take a view beyond the immediate in the share market. There is another even much stronger element to add here, and I'm relying on the analysts who are specialized in researching and analyzing this sector, is that there are a number of subsectors in the REITs where the argument can be made that on the operational side, these companies are actually doing really, really well, which basically means you will get higher dividends, and the risks in having those companies having to issue profit warnings or not meeting expectations are actually quite low. And I've lined up a few of those subsectors here. I mean, my personal favorites are the fund managers on top. I can't emphasize enough to investors that when you invest in Charter Hall or in Goodman Group, you're not really investing in property anymore. You're basically investing in a fund manager, and they are doing a really good job at it, and they're getting a lot of money from international investors. That's the reason why those, in particular, a Goodman Group, for example, is now being priced in the share market as a growth stock. And full disclosure, I own Goodman Group, and I've owned Goodman Group for quite a while, and I intend to own it for quite a while longer. A company like Home Consortium is worth pointing out. They are relatively new on the market, very entrepreneurial, very interesting business model, and I would implore you to do some further research and pay attention to them. But we have some other subsectors here. We have, obviously, the reopening trade returns here with some of the owners of shopping malls. Even though the shopping malls, the foot traffic won't be back to 2019 levels for quite a while, there's still an argument to be made that the recovery will be strong enough to support those share prices and future dividends. And then, of course, we have some sectors at the bottom where you have storage, and in particular, Abacus Property is number one in that sector. And at the bottom, we have land lease companies. Essentially, they develop villages for holidays or for aged care and retirement. And Ingenia Communities recently had to issue a profit warning, but most analysts covering that sector see that as a buying opportunity on a lower share price. Now, I couldn't talk about the Australian share market without mentioning the banks and the resources, of course. And the reason why, even though the risks are accumulating this year, and most equity markets this year are actually down for the year. Up until recently, the Australian share market was actually sitting on a positive gain for the calendar year so far, and definitely outperforming the rest of the world. That is because we have resources, and we have a big chunk of resources. BHP has yet to share its petroleum division with Woodside, but in the meantime, it's more than 11% of the index. So it does make a bit of a difference if that's your local index. Having said so, I would personally say that the outlook for banks is more on the a little bit this, a little bit that side. It's not fantastic, but I do think that those dividends look pretty safe. And in the context of where people are looking for yield and for some sort of protection, the banks won't do too badly in Australia, I assume. The big question mark, of course, is resources. And the question always is, well, how long can it last? Because history shows us all that those beautiful super cycle-like conditions, they go on for a while, but then they change very quickly. I mean, I vividly remember, for example, when the BHP share price peaked at $50 in late 2007. It peaked again at 49 in 2011, and only in the last 6 months or so has the share price returned to $50 and a little bit above it. Just to give you an example that resources are very, very volatile, let's call it, and it's not one straight line up. Now, to illustrate, I thought to illustrate how exceptional the conditions have been for resources and still are at this point in time, I thought I line up for you a top 10 ranking of the largest dividend payers in the world. And as you can see on this little overview, last year, BHP was the largest dividend payer in the world, beating just any other company. And what we've seen so far is that they increased their dividend in February again, and they are most likely to increase their dividend again in August. So the boom times are absolutely exceptional. And imagine that a company like BHP is now the largest dividend payer in the world. It means it beats all the banks internationally. It beats all the telecommunication companies, and it beats the energy companies that traditionally used to be the largest dividend payers. Traditionally, you had the likes of Royal Dutch Shell, of Exxon. They would be sitting on top. We would have American and Chinese banks, and we would have telecommunication companies that would be the largest dividend payers in the world. If I draw your attention to the number 3 position in this list, that's Rio Tinto. And if I draw your attention a little bit further, you also see Vale from Brazil. And then you see on number 10, you see Fortescue Metals. I mean, it's absolutely amazing. And I think probably unprecedented that we have 4 producers of iron ore in the global top 10 in paying out dividends. You can also see, for example, that nowadays Microsoft is in there, as is Apple. And you can it's difficult to see now where the banks are. There's one Chinese bank in there. And you also see a Samsung in there and AT&T. So the AT&T is still in there as telecommunication. There's one Chinese bank, and all the other ones are basically technology companies and iron ore producers. Just to give you an idea of how much the world has changed over the past few years. Now, of course, the question is, this is probably an indication that they are near peak times. And then the question, of course, is how long can it last? It's a question that everyone breaks its head over. And so far, what I can report back to you is that most analysts are now assuming that these boom times can last at least for the next 6 months. But as we all know, at the moment, there are some worries about the Chinese economy picking up. So you never know. But in case you had those stocks, you've had absolutely ball of a time so far. Now, the big elephant in the room this year, of course, is what are we supposed to do with technology stocks? Over the past few years, it was very difficult to make a fantastic return from equities if you did not own technology stocks. Now, people always like to comment on the share markets in terms that the general direction is being made by traders and by robots and by algorithms and all of that. But I always refer back to humans. And humans, that's us. And we just can't withstand the fact that if a share price is rising, that we want to get on board. And to illustrate that, I thought I'll take a company that whose name is probably very well chosen in this context, and this is Redbubble. And I do think that we have seen a bubble in technology stocks over the past 2 years. And you can clearly see that on this price chart, where if you look at Redbubble, which is essentially an online platform where artists sell their wares to consumers. And you can see that prior to 2020, the share price moved up a little bit, it moved down a little bit, but we weren't all that interested in Redbubble. And we were all questioning, as I still am, we were all questioning whether this was actually a lasting, durable and profitable business model. Now, all of a sudden in 2020, you see what happens. The share price essentially appreciates by 300%, 3 times in no time. And then it gradually comes off, and then all of a sudden it goes very, very fast. And it's still not at the same level as where it was in 2019. I mean, I'm still questioning the longevity of a business model like this one. But obviously, when businesses, when economies went into lockdown, businesses like Redbubble were the place to be. And it shows you probably how difficult it is to withstand the general trend in markets. And I sincerely hope that you weren't there when this trend turned, because what we have seen over the past 9 months or so has been a correction that is probably the most severe in living memories that we've seen in a sector like the technology sector, which then obviously bodes the question: what is the outlook for this sector? Now, I happen to believe that investors are at the moment treating too much technology with the same brush. And there is a difference between profitable business models and the fly-by-nights, which potentially is something like a Redbubble. And I personally have been an investor in technology in Australia for a very long time. I think investors underappreciate the technology we have available on the share market in Australia, even though those businesses are not necessarily labeled technology. I mean, they could be in the healthcare sector, they could be in the property sector, for example, and in the usual suspects. I've lined up a few here. They range from car sales to ResMed, to REA Group and Seek and a whole bunch of others. I mean, these are very solid business models, high quality, high growth, with still a long runway of growth ahead of them. It's just that over the past number of months, they were on the wrong side of the market, and they've been sold down on occasion quite heavily. But I still believe that those companies will return back in favor, and they still have a long-term profitable future ahead of them. We also have in the middle part, the more companies that are more typically associated with technology, and of course we have Technology One would be one of my all-time favorites. But you also have Pro Medicus and WiseTech and the NextDC and Zero. Again, these companies do not necessarily, with the exception of Technology One, they do not necessarily have the same track record as the companies I've lined up earlier. But I would definitely think that once the whole storm, which is specifically related to technology stocks, once that lies down and those companies regain favor again, that they do have a very multi-year, long-term, profitable future ahead of them. At the bottom, I've lined up a few other companies that, again, you can argue they have a little bit of a higher risk profile, less of a track record. The likes of Megaport, Nitro, they're not profitable, which and Ordinate as well, which in this context means they definitely find no favor. But at some point they will, and at some point, whatever is holding them back, I believe, will pick up again. I guess the message here is don't throw out the baby with the bathwater, and don't assume automatically, because those companies can find no fans in the share market today, that will last forever and ever. Now, we'll take a little bit of a sidestep now. I think a lot of people underestimate the value of gold, and on occasion, I have to count myself amongst those people. But I have gradually come to the conclusion, in particular in a year like 2022, that we should all have some exposure to gold, one way or another. And the reason for that is that, first up, I think investors buy gold for the wrong reasons, and that's why they're disappointed, and that's why it doesn't work out. I'm on social media, Twitter, for example, and I see a lot of people being very frustrated with their exposure to gold. Now, there's two reasons for that. They either own gold producers, which is not the same as owning gold, and the same reason is they think that they have a protection against inflation, and they don't. That's the two reasons I believe for the disappointment in owning gold. See, the details when investing, details matter. And I believe that gold is a very lousy protection against inflation, but gold is a very good protection against high inflation. And gold is also your insurance policy when the world goes down to hell in a basket. And if you believe that risks are rising, and that the risks to share markets are rising, and that maybe the risks to global growth are rising, and we could see all kinds of nasty things happening, and including central banks making mistakes, then gold could be a very good insurance policy. Now, the added observation I can throw in here is that I've lined up here the performance of gold over the past 22 years in US dollars, and if you add it all up and you make an average, then you can conclude that gold has a similar performance as the equity markets over time. It's just that sometimes it performs in line with equities, and sometimes it performs opposite, contrary to equities. And of course, the second reason is why you have some gold in your portfolio. When your equities are tanking, hopefully your gold is rallying to the other side. And that's, to me, the key reason as why I would have some gold in the portfolio. How much of gold do you need to have? My philosophy is very simple. You make it directly relatable to your comfort or discomfort with the world. If you're really worried now, buy more gold. If you're not that worried, buy a little bit. That would be my philosophy. Now, I've already mentioned it earlier. Buying gold is not the same as buying gold producers, and in particular in Australia, because you also get, apart from the fact that you get a specific company risk, you also get the currency risk, of course. But beyond those details, I think this was worth highlighting in today's presentation as well, I think, because a lot of people might be thinking, I want to have more profits, more gains if possible. And you can get more gains out of producers than you can get out of a gold ETF or something similar. And what you see on this chart here is that the goldy line, that's your gold, and the blue line, that's your the index of global producers. And what you in short, what you see here is that at the time when gold is wanted and gold is in favor, then the producers trade at a premium to the metal, which basically means you make more gains out of your producers. On the other hand, when gold is not so much in favor, you see the producers go and trade at a discount to the metal, which basically means you make losses out of your producers when you do not necessarily make losses out of gold. And if you do make losses out of gold, you make more losses out of your producers. So there is your risk profile. You can get more out of it in the good times. You will lose more in the not so fantastic times. Now, for those amongst you with a little bit of a higher risk profile, and I have to emphasize, this is not for everyone. There is a specific strategy that you can employ with gold producers, and the strategy is as follows. If you have a gold company that has one asset and it's not yet producing, if you buy it in the months leading up to first production and then keep it until it's ramping up its production, the gains that are potentially on the table could be no less than enormous, in particular if we go through a period when then all of a sudden gold is wanted. But that's on the premise that nothing goes wrong in that process. And as you can see here, I've lined up some of those assets that have been in that situation. And if it goes wrong, you see share prices going off by 83% or 55%. So the losses can be quite severe if things do go wrong in that process. If they don't go wrong, you can make a lot of profits. You see here, for example, here's a 72% and a 152% gains. Now, at the moment, there are 4 companies on the stock exchange that are in that particular position. And the one I can highlight is Red 5 here, which from a reading resources analysts research, the overall sentiment towards Red 5 turning into a winner are accumulating, I should say here. But again, there's no such thing as a guaranteed success. Now, we've done the individual stocks. I could not possibly have a presentation to you and talk to you about the share market this year without talking a little bit, at least, about the more macro picture. And the macro picture will hopefully explain to you why I have become more of a cautious investor this year. And problem number one we are facing this year is that, of course, we now all of a sudden have this outbreak in inflation, and it doesn't seem to be willing to come down without us doing something about it. Now, we can all discuss whether the central bankers are behind the curve, whether they should have acted previously or whether they should wait longer. It doesn't matter at this point in time. It's very clear that central bankers are willing to attack inflation, and they will raise the cash rates and push bond yields higher. What we should be worried about, though, is that if inflation, irrespectively of those actions, will stay higher for longer. And the obvious reference to make is that we had such a period in the 1970s, and I can assure you that all of us would not want a repeat of the 1970s. The problem we have this year is that inflation is predominantly and above all a result of supply problems, whether they be caused by COVID or by borders being closed or by companies not finding enough staff or by the war in Ukraine. It doesn't matter. What does matter is that inflation is still rising across the world, and we can't have it for staying higher for longer. Now, there are some economists out there, and this is the reason why I put this up. There are some economists out there that believe that we already lost the war against inflation, which basically means it's going to stay much higher for much longer. And the reason why they think that is the case is, and it becomes a little bit technical here, but it is a scenario that we should all be well aware of. This is the 1970s when inflation was very high. And what is very remarkable here is that if you correct bond yields for inflation, then you see that the gap between where bond yields essentially are and where inflation was in the 70s is very, very wide. It has never been this wide. Now, there are some economists who believe that that is the reason why inflation stuck around for much longer at a much higher level. And why is that disconcerting? Is that if you go to today's situation, the gap between bond yields corrected for inflation and between where inflation is has never been this high since the 1970s. It's not similarly high, but it is very, very high in comparison. Now, if this theory holds true, we should all be worried. In the 1970s, you can look this up. The only thing that worked was gold and trading. Both bonds and equities had a terrible time in the 1970s. And I personally believe that we will not see inflation sticking around for long, and that we will not relive a period like the 1970s. But I'm putting this up because I'm very well aware that I can be wrong too. And as investors, we should all be mindful of that this is a possibility. It's not a plausibility, it's a possibility. Now, the other thing, of course, is that, and you probably will, if you follow markets, you will have at least picked up a little bit of this. It's the so-called curve inversion in the US bond market, where essentially short-term bonds have a higher yield than long-term bonds. Now, is that a sign of recession? Traditionally, it usually is, but it's not like the bond market all of a sudden is Nostradamus. I mean, what the bond market essentially is telling us is that there are worries amongst investors about global growth. And if we are worried about global growth, and so far corporate earnings are, the forecasts are still rising, well, all else being equal, you should conclude that, well, maybe those corporate profits will come under pressure at some point. And that, I think, is for us investors in the share market. That's the key thing, I think, that we should take away from the bond market, expressing its concern about growth going forward. In particular, given that central bankers in the United States are preparing the markets now that they will accelerate their tightening. And there are now forecasts about that they won't move by 25 basis points, they will move by 50 basis points, and potentially by 50 basis points multiple times in succession, because they find themselves in a fierce battle with inflation. Now, as we all should be aware in Australia as well, there are already forecasts that the housing market locally will come under pressure from the moment the RBA will start hiking, and that is potentially only weeks away. Those things will have an impact. Those things will have an impact on businesses in that sector, and those things will have an impact on the economy in general. So it's probably not such an outrageous forecast to make that growth in the second half of this year and throughout 2023 and potentially into 2024 will come under pressure because the dynamics are changing. And this, of course, should also be taken into account with our stock selections and how we are positioned with the portfolio. That's what a cautious investor does. Now, at the time when I put together this presentation, oil prices were very, very high and very, very threatening for global economies. Also because Russia is very important in that aspect, of course. At the moment, that threat has fallen away. Oil prices, last time I checked, are now below $100 a barrel, which is in the bigger scheme of things, that's actually quite low. But they were previously threatening to 150 and beyond. Traditionally, if that happens in such a brief time, we do get recessions because the impact of oil on the broader economy is too high. It's similar with bond yields. I mean, it's not that the world can't cope with expensive oil or with high bond yields. Of course, the world can. The world has done it before. It's just that if the change happens too quickly, and that's early in the year, I thought that was a major threat when it looked like the oil market was coming under severe pressure, and 150 was not out of the question. That even though some economists will tell us that the importance of oil for today's economy is a lot lower than the 1970s, I still think it's something to look out for. Commodity stocks, commodity producers, commodity markets, they tend to dig their own grave when prices go too high. Ultimately, the fall will be quite severe. Now, on the positive side, and those who pay attention to what we do at FNArena, we do pay a lot of attention on corporate profits, and we will again be ready to do so in August. But when we went through February, we were actually a little bit sad, because February in Australia was one of the best reporting seasons I've ever witnessed over the past 22 years or so. But unfortunately, we had a macro picture that there was a lot more happening, bond yields and portfolio reshuffling and stuff. So it didn't really matter that much in February. Corporate results were really playing second, if not third violin. But the positive news out of the February reporting season is that businesses in Australia are relatively well positioned. They're in good shape. And I gladly copied this chart from CommSec after the February reporting season. And what this shows you, in short, is the amount of cash that Australian companies are carrying on their balance sheet. And you can see on this one, over the past decade, it has never been this high, and it is well above average. Now, CommSec itself thinks this is because businesses are gearing up to buy other businesses and to start spending on CapEx and to expand in new markets. I have a little bit of a different view on this. I think that the uncertainties for businesses are seldom as high as they are today, and businesses have responded by hoarding cash. Whatever the reason, it's not bad news. It means that we will, if things do turn sour at some point, and I'm in terms of the global outlook, I think we should all be prepared to see a recession in Europe. We might see a recession scare in the United States as well, in particular because the Federal Reserve has to go hard on rates over there. The recession forecast for Australia would be at a very low chance of happening, but it doesn't mean that Australia won't be impacted by what happens internationally, of course, and in particular the companies that are listed here and have operations offshore. But at the very least, we can see that those companies listed on the ASX are predominantly cashed up, and that should be some level of comfort in terms that we go through some tougher times. The irony about the share market is, of course, that the valuations haven't been this low for a few years, and all of a sudden we are worried about share market valuations. Never underestimate how markets operate. As you can see here, is that valuations in general have come down quite a lot for the Australian share market. I mean, at some point, the PE ratio for the market went above 20, and at the moment it's 15 something. Now, there's two comments I'd like to point out in this regard, is that the big rise we saw in this period over the past few years, we should all take into account that when we work off these generalized statistics, that there's a lot of subtlety in the details. And as you may or may not know, one of my favorite stocks in the share market is CSL, and there was a point when CSL became the largest constituent in the local index. And CSL doesn't trade on low PEs. CSL trades on high PEs. So the fact that CSL became the #1 stock in the index at some stage was calculated by UBS that added 100 basis points, like a whole full percentage point, to the market's valuation in terms of a price earnings ratio. So one stock made it basically go past 20, and otherwise it would have stayed into the 19 something. Now, in the same vein, today, we have BHP now having an index weight that is double what CSL used to weigh. And of course, BHP trades traditionally on a very low PE ratio. So the valuation can be argued today is artificially being depressed by the fact that BHP is now such a large constituent in the index. And it trades on relatively low PEs because that's how resources companies work. When they have a humongous ball of a time, you want to have them on a low PE trading. So I think the message here is don't get stuck into the generalized statistics, pay attention to detail, and be aware that individual stocks in a market like Australia can make a big difference in the general statistics. There's more good news, and I believe this is one of the reasons why the share market earlier in the year had a very swift recovery throughout March from the lows that were seen after the very turbulent opening weeks of the year. There's a lot of quant analysis going on these days. And that quant analysis is usually very straightforward. And you can see it on this particular table as well. People go back in history, they see like what happens when the share market has a very bad start to the year. And surprisingly so, often that means it will have a good end to the year. And you see it on this table. In most years, going from 2009 to 2020 and even going into the 1930s at some stage, if the share market has a very bad start to the year, it usually picks up and has a positive end to the year. However, that is not always the case, of course. And I'm certain those of us who have been in the market for long enough, we still remember 2008 when we had a very bad start to the year, and it didn't get better anytime soon. So the question, the observation here was, of course, that so if the economy goes down the toilet as well, then of course the share market will not recover from its earlier sell-off. And this year, of course, the big question marks are, amongst other things, about what the economy is doing globally. So don't take this as a gospel, but you see that the odds are pretty much in favor of a good ending on the assumption that the economy holds up and the Fed will not make mistakes this year. I'm going to talk very briefly about what has been happening so far, and that is the world seems to be dividing in multiple camps again. And there was a lot of speculation that Russia will cozy up to China and that they will form a bloc one way or another against the more democratic West, which obviously we are part of that. We have to wait and see how exactly that will develop. But of course, if this develops, it will have major consequences for a lot of things. I mean, our access to commodities, the supply chains globally, etc., etc. There are plenty of countries out there, not just Russia, but potentially China and some others as well, who would love to have an alternative to the US dollar, to US treasuries, and to US assets. But the way the world is structured today, it is very, very difficult to diversify away from anything that is the US. It is still the largest market with the most powerful central bank and the global currency. But that doesn't mean that they won't try to find alternatives. If you're into cryptocurrencies, here's your justification, because there's a narrative that goes that those countries like Russia and China will increasingly put some of their assets there, but we'll have to see how that eventually develops itself. I mean, I'm very loath to make very firm predictions here, because I do not think that any of us knows how this will develop, but it is a process that has started. And then the big question mark that I think people don't talk enough about, and that's also because we don't really know that much about it. But central bankers, as you all would be aware, they have been injecting a lot of liquidity in the global system over the past years, post GFC. many economists, many market watchers, many market observers are convinced that that has translated into higher prices for properties globally, for equities in general, for risk assets in general. I mean, the whole narrative, for example, about how the cryptocurrencies would form protection against inflation, that has obviously fallen flat this year, and that's because essentially cryptocurrencies and NFTs and risky assets are as much linked to global liquidity as are global equities itself. But we should all be aware that while we don't really know how liquidity essentially works and how much it has impacted on the assets that we have in our portfolio, we should all be aware now that if there has been a positive impact, then we should now expect a negative impact. Central bankers are hell-bent on reducing liquidity, and maybe, as you see on this chart, what we saw already happening before the midst of last year, we saw small caps underperforming large caps gradually and then very, very fast. And of course, ultimately, we get a big sell-off in technology stocks. We get a big sell-off in cryptocurrencies. NFTs have been absolutely annihilated. Maybe that's all in response to a reduction in liquidity that hasn't genuinely happened just yet. And this is definitely something that should be on our radar. And again, another reason to dial back, I believe, on the more risky strategies and the more risky behavior, and we should retreat now to I think to more cautious asset positioning and portfolio compositions. Now, having said all that, I hope I haven't put too much depression in all your minds, but last time I presented to you, I mentioned that I run a portfolio around my own research into all weather stocks. That is still the case, and we have moved to a new platform which makes it all cheaper to run as well, cheaper to put your money there. If you're interested, I'm always around to answer questions. The other thing is, if for some reason you like my approach to markets and to research, I'm actually a better writer, I believe, than I am a narrator, and I do write a lot. I put together a secret report which gives everyone access to some of my more writings and to stimulate your thinking and shine a light on elements that may not necessarily be very obvious from day-to-day observations. That secret report is very easy to obtain. You just put /secret behind the URL of the website. It also gives you an opportunity to potentially have a trial to the service. And now I have come to the end of my presentation.